break from two key lenders, Wells Fargo and Discover. The Wells Fargo program is available to borrowers whose employment or income has changed since they began repaying those loans, and those loans need to be late but not in default or delinquency quite yet. In some cases, Wells is willing to slash the interest rates all the way down to 1%. Discover is still working out the details of its program. Wells Fargo's John Rasmussen said the bank began evaluating options as borrowers' profiles began changing.
We started to hear more and more feedback from our customers that solutions that we had for them in the past weren't working enough for them because of the tough economic times for students coming out of the financial crisis. So that's what stepped up our priority.
But for years, the Consumer Financial Protection Bureau has been criticizing private lenders, writing just last month that the lack of refinancing remained what it called a major pain point in the market. Now, we should note private student lending, it's always been a smaller and relatively safer market. Wells and Discover together have about $20 billion in outstanding student loans. By comparison, the federal government, $1.1 trillion. Default rates at the government level, 14%. At the private level, less than 2%. So one of the reasons that the industry says they haven't needed to do this is because they haven't had as many defaults. They haven't had as many borrowers with complaints. That being said, the fact that the government has had a modification program in place for so long without it in the private sector does make you